Good morning, everybody. Kirk Spano. It is May 6th, 2023. I want to give you about a 20-minute update on Amedis, answer some questions if you have any, and then get back to my vacation. All right, on to Amedis. I wanted to talk about a couple things. First of all, before my meeting with the Amedis management, I pretty much knew what they were going to say. I bought more shares of stock down in here, and I bought calls, January $7.50 calls for about 15 cents. After the meeting, I was afraid that I would be upset about what I did. I am not. I am very encouraged by what I heard. In particular, a couple of things. They actually answered all my questions before I got there, other than an accounting question that I had. So I'll go through that in a minute, too. I will tell you that Eric McAfee is way ahead of any of you when it comes to your analysis of the company. And anybody who thinks that he's not being straightforward is either confused, huckstered, emotional, or just doesn't understand small company investing. I mean, it's one of those things because everything they have done has been ridiculously transparent. All you need to do, go to their webpage, go to the press releases and SEC filings. Every last thing is there. I don't know what to tell you. There's a short attack going on across all sorts of stocks. The biggest example of a short attack recently, other than Amedis and some of the small caps, is the banks. You saw all of the banks get crushed for a couple of weeks, even though JP Morgan and the Fed and the FDIC were stepping in to shore everything up. And then what happened on Friday? One of the stocks went up 80%. There's the mother of all short squeezes on a bank stock. The market cap, like $10 billion. So this idea that price is truth is bullshit. You have traders being traders, and if you don't want to hear that, then you're not in reality land. The simple reality is this: just like the news stories that make everything seem negative are amplified because of the internet, same thing happens with stocks. Is that you get traders into a trading room, with Discord and everything else, and they collude, push stocks around. That is what's going on. If you're trying to trade in the middle of that process, you're making a mistake. Now, sometimes you get surprised, and a short attack is way more effective than it's ever been in the past. And we've been seeing that for the last year. Because you have twice as many traders as there was before COVID, right? From 10% of the market to 20% of the market. Just have to think of how much more of the float they can impact and how much they can do with all sorts of, frankly, millennial and a handful of Gen Z traders using leverage, using margin. They have power to do that in both directions. I'm going to tell you exactly how a short attack works. I was going to write an article about it, and I still will. But a short attack works like this. A hedge fund or some other investor, but generally a hedge fund, takes a short position in a stock. And then, and they already know these people, they go to their 2, 3, 4, 5 favorite mouthpieces on the internet, in the Discord rooms, in the trading rooms. They say, hey, Blue Horseshoe hates shit stock or this stock or other stock. They've been doing it to all the small caps. Why? Why small cap? Because institutions don't own 80 or 90% of the float, right? Because they have rules. Institutions have rules on how they invest. And they may only own 30, 40, 50, 55% of the float in the case of Amedis. And they can push it around. And because old men, and I'm saying old men because old men don't usually invest in small caps. So not only are they short on institutional money, but they're short on old man money, which is who should be investing in these companies. But they don't because old men. I don't mean all old men. I know that we have an exceptional group here. But in general, most people who invest are bad at it. They invest in the indexes and they pay extra to do it. Why? Because they'll own 7 or 8 or 9 or 10 mutual funds, paying, a point or 3/4 of a point or 1.5 on those funds, but taken all together, it's just the index. So they're paying a point to be in the index, which is dumb. If you're going to be in the index, if you're going to be an index investor, then buy SPY and pay 6 basis points. We have all these closet indexers out there who think they're smart, they're not, paying extra to do something that should be cheap. It's like Homer Simpson when they came out with the Simpsons movie, and the first joke was, haha, you suckers, I got you to pay for something that's free. So don't discount the idea that 4 out of 5 investors suck, because they do. I've been trying to get you to become better investors by telling you how all these things work, and a lot of times it's met with disbelief. Well, hear me now, believe me later. I'm telling you this is how a short attack works. If it was an institution or guys like me doing it, it would be illegal. How are you going to police chat rooms all over the internet when they decide to collude and beat down a small cap stock, because mathematically they can do it for a while using leverage, because they can sell 2 shares to every 1 share you can buy. Think that through. In case of Amedis, about a quarter of the shares are in the float, right? Because insiders, institutions own the rest. And they are able to use margin to sell whatever it is, 10 or 12 million shares short, because it's small cap, because the public doesn't look at it, because they're bad investors. I'm going to tell you something right now. As soon as a few million shares of Amedis get bought, the short squeeze is going to push this stock somewhere in the upper teens or low 20s, maybe higher. That's all it's going to take, because there's hardly any shares out there to be bought. So once this short squeeze happens, it's going to be a spike. You have to figure out how to deal with that, because then it'll settle back. So I want to show you this chart first. This is the last 5 days. Fell off a cliff with an earnings announcement that was inconsequential, because they were able to put on the internet, hey, they didn't tell us that plant was shut down. Well, yeah, they did. And they warned you ahead of time twice, in November and December. All you gotta do is pull it up right here. They talk about it in their documents that it could happen. And on November 5th, you knew that the solar microgrid was being built. So at some point, they were going to have to shut down for a little while. They decided to do it when the price of natural gas was through the roof, and it became uneconomical to power the biofuel refinery. That's smart management. They warned you twice, and they told you twice. And if you didn't know that, that's on you. It doesn't really matter anyway. All refineries undergo maintenance. They pulled forward a bunch of maintenance, got it built fast, and now they use 60 to 80% less natural gas than they did in the past, because they're using a solar microgrid instead. They're using artificial intelligence from Rockwell Allen Bradley, which is out of Milwaukee. So I'm going to track that down. I want to see what that's all about. And all of a sudden, this biofuels refinery is their ethanol, but it's going to move the other direction over time to do other things, because corn is not the future. Agricultural bio-waste is. Cries of not transparent are just, I don't really know what it is, but I know that it's planted a story, get people sell their shares. This is mainly the shorts going nuts. And then some people sold here and here. Big deal. I know a lot of you bought right down in here, because you understood how, when it started going like this, you knew what that was. Some of you bought in the 120s and 130s. Very smart move, in my opinion, because those shares are already up 50%. Think that through. You made 50% in 12 hours. You bought down here instead of selling. And what does this look like? Look how orderly that is. And then right at the end of the day, Friday, it dropped a little bit, probably because some of the traders sold. What does that look like? Does that not look super orderly to you? Like maybe the early shorts who planted the idea were covering, but they haven't told their friends yet, because they're not going to tell them. If they tell them, remember, there's 2 or 3 Kevin Bacons removed here, right? They maintain plausible deniability, because the guy who runs the chat room doesn't say which hedge fund told them the idea. They're patently dishonest people, but they're giving their followers just enough to have hope, and then they burn them. Turn and burn. And pretty soon the millennials are going to figure that out. Millennials already know to be looking at private equity and Bitcoin, international markets, but the reality is that the government and the central banks and the Federal Reserve in particular are on the side of the stock market. You're going to see a mega boom in stocks after this correction, whenever it finishes up, is over with. Maybe it did bottom in October. I still don't think so, but maybe. Federal Reserve stopping raising interest rates, by the way, is not the all clear sign. Usually the all clear sign is about 6 months after that. So if the interest rate rise on Wednesday, the raising of the interest rate on Wednesday was the last one, count out 6 months. That's typically when the market bottoms. That could be 3, it could be 12. But the market usually bottoms after the last rate cut, not before, especially not 7 months before. Anyway, this looks pretty orderly to me. It doesn't mean that you can't get one more dip. And as soon as there's buying here, I mean, you all understand how low the float is here, right? Right? Do you know how low the float is? Have you bothered to look? Yeah, right here. There's 36 million shares. Public owns only 45%. I know that the people who follow me and myself own 2-ish% of the company. I know of a group in the UK that owns 1-ish% of the company. When it comes down to it, you really have about 25% of the shares that are active, trading about 500,000 shares per day, and that's with the increased volume lately. So you have 500,000 shares a day that have been moving the stock around. So on a day where you get 2 or 3 million shares being traded, it's largely because of margin, people freaking out, and the traders trading the same stock 3 times in a day. There's not some mass exodus of money from Amedis. In fact, one of the things that was noted both in the call with me and the conference call the day before, this is the script for the conference call, is that they have about $57 million of tax credits just sitting there waiting to be recognized once the IRS writes the rules, right? It's already law. Just waiting for the guidance. So anybody who's dealt with taxes understands you got to wait for the guidance letter. You've all said you want to see cash on the balance sheet here. You've all said that you want to see money coming in. How are you going to feel when all of a sudden $57 million drops to the bottom line over the course of the next 3 or 4 quarters? What do you think is going to happen when the India money starts flowing in regularly? What do you think is going to happen when they float 10% of the India plant, which is something that we talked about? India is probably going to get floated early next year, from what it sounds like. I understand why he's doing it. He explained it to me a second time. So let's go through some points one at a time. First of all, somebody asked, what do I mean by the float? Google that shit. The shares outstanding minus the ones that don't move. It's the easiest way to understand it. Institutions aren't trading. The public is essentially the float. It's not the official definition. These are the shares that move around. Not like the institutions are sitting there trading their shares. They can't. It's a retail investor. So when you only have 20 or 30 or $40 million that can move the share price, it doesn't take a lot of money to move the share price, especially when you're using margin. So the small cap stocks are extremely vulnerable to short attacks. But as long as the business is doing fine, usually you get a massive short squeeze after that. Stock rolls 50% from its bottom in 8 hours, 12 hours, whatever it was. You say, well, but that's only back to where it started almost. Well, still 50% if you traded it right. So this idea that there's massive amounts of money flowing out of a stock because the share price goes down is wrong. It's not how it works. It's the shares that trade that are impacted because 4 out of 5 people are bad at it to begin with, tend to panic when they see the share price go down and they sell. Then they rationalize it, but say, they tell me something. Had they told you, we're going to close this plant for 3 months for maintenance, you guys sold your shares? No, but when it becomes a story on the internet as the share price goes down for no apparent reason, because anybody really paying attention knew they were building that microgrid because they told you. I mean, man, so a few things. First off, the question that I asked them after I got the elevator speech was I wanted to know how the IPO in India would work when they do it. They already have investment banks asking to do the business. They could float the India shares anytime they want to. So they own 100% of a debt-free company over there. The way accounting works, and this is important, is that if you own 51% of the company, you can accrete it to your balance sheet, but then you have to discount out the part of the company you don't own. At 80% ownership, you can just accrete everything to your own balance sheet. You don't have to discount anything. So for example, if your investment in a foreign company or any other subsidiary really was making $100 million and you own 51% of it, you could put 51 million of those earnings or revenues onto your balance sheet. But if you own 80%, you can put the whole 100 million on. So that 80 is a hurdle. You don't have to discount after that anymore. You don't have to account for the parts you don't own. That makes sense? So when they float India, they'll float less than 20% initially. They will IPO less than 20%. Somewhere between 10 and 20 is what it sounds like to me. Because he specifically said, if we get $50 million out of that, how do people feel about that? $50 million out of India. Remember, he said that the IPO price could be up to 900 million. I said something 500 million or higher, right? 300 million in a private sale. So let's say they get the midpoint. Let's say they get a $700 million valuation when they IPO the India plant in India, which is a huge thirst. There's only 4 biofuel refineries out there. And the one that Amedis owns is the biggest one. And it's the only foreign held one. So they would love to get some of the shares into the hands of Indian investors because not only does that put money in their pocket, but it de-risks the investment a bit, correct? Be treated better if you're on the India exchange than if you're not. So when they float it, again, sounds like early next year because they want to maximize the valuation. But let's say they get to 700 million. They float 10% of it. That's $70 million in their pocket, less fees. He offhandedly mentioned, what if we just pull $50 million out? So on the right track. Might even float, might even IPO single digit amount. We'll see. At some point, if the valuation goes higher and higher, they do a secondary or they sell it outright. Easy enough to understand. So that's coming. The India plant is worth a minimum of $500 million. Depending on the price of fuels in the future, could go over $1 billion. But somewhere between, I think his number and my number, 500 to 900 million is probably right. He's probably closer than I am. Can you see this company doesn't have any problem? Third Eye Capital could get them. Horseshit. Okay, shut up with that. If Third Eye Capital wanted to own that company, and I've been telling you this for over a year, they already would have. How many extensions have they had on that debt? How many refinancing? They don't want to do that. The reason why they're calling in the preferreds is because it hurts their investment. Third Eye Capital is a huge equity owner. All those warrants. Third Eye Capital makes money when this stock goes up. So they want to get the preferreds called in as soon as possible. They don't want to have that interest rate on the books. Doesn't look good for the private equity firm either. They're inching them towards monetization. But because they know that we have this domino wall right now of catalysts, they'll probably just give them an extension to early next year sometime. But maybe they'll throw them a couple dollars as well. Take a note, whatever. Third Eye has been working with them for a very long time. They make the most money when this stock price goes up, and they know that they're close. So they're starting to package it in a way financially so this thing can run to as high as it can go. Both Shooter's new charts and my charts both say it can go over $100 a share. Take that for what it's worth. That's more longer term. That's 3, 4, 5 years. But just on a short squeeze with a couple million shares bought, right? Because there aren't that many shares. Just a couple million shares here get bought. For example, let's say an institutional investor comes in here and says, I want to own 5% of that company. They can do it in one day or they can do it in a week by systematically accumulating. When they hit the 5% threshold, they have to report it. I would be shocked in the next couple of weeks. And Eric hinted at this, but he can't say it. And I do know that he was on the phone with Raymond James when I got there. I think that there's institutional accumulation probably that just started again and is going to continue until you see a couple of notices. There's more institutional shares being bought. So anybody who's sold down here, so I'm going to take the tax break, shame on you. Don't move. You let traders create volatility, shook you out. Sold at the bottom. I've made it clear there's no financial risk with this company. If they have to, they can monetize India anytime they want. They don't have to. So they don't. They're allowing the catalyst to stack up and come down naturally and maximize the value rather than jumping the gun. Because people are going, I know I'm coming at you a little bit here. When Exact Sciences went from 30 to 20 to 12 to 5, and this is different because there wasn't any inside information there. Kevin Conway was able to just buy shares. So did a bunch of other executives. Because there wasn't anything new. There wasn't anything going on. So they were able to do it. I know, because I talked to a couple of them, I know that they'd like to buy shares right now, but they can't because they know what's about to happen over the next several months. And they covered most of it in the conference. And remember, Eric McAfee was just on Capitol Hill testifying. Everything here is lined up between June of this year, early next year, start dropping numbers to the bottom line. The first catalyst, whenever the IRS writes the tax rules, which they've said will be in June, they're usually close with the dates that they give. IRS usually doesn't give guidance and not deliver. All right. Somebody says, it seems like there's a lot of stargazing around various government incentives. No, it's the goddamn law, man. This is all law already. They're just waiting on IRS guidance. The Inflation Reduction Act put all this stuff into effect. Go read the Inflation Reduction Act on the IRS.gov website. Don't repeat something that somebody else said if you haven't done the research. Oh, stargazing. The LCFS credit out of California is market driven and it's at the bottom of its cycle right now. And there are a couple extraneous factors that, drove it down a little bit further than they wanted. But the state of California has said, they want to see that price get back up to $250. They want those tax credits selling for $250. The state of California, right? What's part 2 of our process? Follow the state of our process. Follow the government, central banks. In this case, you have the state of California saying, hey, that $65 price is too low. We're going to drive it up. What's the price today? Since they said that, whatever it was, 3 or 5 weeks ago, up to 86 already. They've said they're going to push it to 250 by tweaking the rules. That's all they have to do. And they're on slate to do their meeting in June, and in July or August probably have the new setup. It's not like this doesn't exist. It exists. That marketplace exists. And Amedis could sell their tax credits at $86 right now. And they're like, no, we're going to hold on to them until the price is going up. The state of California just said they're going to push the price up. And it's going to get to 250. You know why? Because the real cost, all of the rules on clean air and everything else is way higher than that. So even if somebody comes here and says, well, buy your tax credits for $250, they're still probably making $100 or $200 spread based on their business, right? Because if a utility comes and buys it, or Exxon comes and buys those tax credits, or Chevron, that's who the market is. The market is the utilities. Exxon and Chevron, the heavy industry. They do their own math about what those credits are worth to them versus what they can buy them for on the open market. Those tax credits are always priced lower than what it would cost you to bring down the cost of your pollution, especially with the environmental laws getting tighter and tighter and tighter. I mean, you see a press release from the White House every month that they're tightening up something through the EPA. Not a big fan of regurgitating. I'm going to tell you, go read the transcript. It's up on Seeking Alpha right now, and I have it here. Read the transcript. Then go read the quarterly report. If you have fear in your heart, if you're scared because the share price went down and you don't understand why, because you think there's millions of people selling shares, it's not. It's literally a few hundred people using margin. That's what it is on a stock this small. What happens, I know that some of you beat me. I get it. What happens when 1,000 investors come in there with $10,000? What happens when BlackRock puts $1 million worth into the iShares? I mean, they already have. But what happens as the price goes up? Well, a lot of these indexes are market cap driven, aren't they? So as the price of Amedis goes up, the ETFs have to add more of it, correct? That's how that works. The short squeeze here is going to be spectacular when the institutional buying comes in, and then people like us who actually have an understanding of what's going on buy even more. I will tell you, this is my personal largest position now after Thursday and Friday. I have about 10% of my money in stock and about 3% of my money in calls. I bought the January $7.50 calls. You'll see 1,200 of them traded Friday. That was me. See if I can pull that up there for you. I'll just do it the easy. Well, there's use NASDAQ. NASDAQ, AMTX options. That's how you do that. There you go. Boom. Put this on the top. I don't know if it's in your way or not. It's in my way. Oh, come on. Don't make me go to Yahoo. Now, here's the interesting thing about buying calls. Creates pressure on the market maker. Well, I bought 1,200, so they don't have mine up yet. So it'll probably show up on Monday. So this is what I was buying. January, $7.50s, and I was getting them for 14 and 15 cents is what I got them for. So of the 4,000 open interest there, I'm presuming that's going to jump up to 5,200 on Monday. So the 1,200 I bought on Friday morning. Of the 5,200 that are going to be outstanding open interest on Monday morning, I believe 3,900 are mine. I'm largely the market there. They're just so cheap. Now, let's do some math here. The stock is $1.90, right? Call it $2. You're getting almost no leverage buying the 250 call, and you're adding calendar. So you don't want to do that. The $5 probably get for 20 cents to 30 cents, probably 30 cents. Oh, it says last 40. Last one's 20. Let's say 30 cents. So let's say you bought the January $5 call at 30 cents. You know, you buy whatever, 100 of them, and that costs you, $3,000. Right? Because it's 100 options times 100 shares per option is 10,000 shares. And then say 30 cents is what the price is. It'd be $3,000. So you put $3,000 into buying those $5 calls. Here's what it can do for you. That stock goes up to 10. That means it's in the money by $5. You spent 30 cents. It's a heck of a multiple to go from 30 cents to 470, isn't it? Or up to 5. You make 470. That's 1,500%. I did the 750s at 15 cents because I wanted even more leverage on the potential for it to go to, say, 20. Now, if my target price is 10, I probably want to buy the $5. I think my target price is between 17 and 22. So if the stock price goes to 17.50, just to make numbers round, that means that my calls that I bought for 15 cents are now worth $10. Quite the return. My opinion here is if you are a serious growth investor and if you want to put pressure on the shorts, you should start buying these $5, $7.50 calls for maybe 3, 4, 5% of your total position. Do not sell shares to buy these. Buy these out of cash and out of cash only, because the market makers have to balance their book. The market makers have to buy stock in case the calls are assigned and they have to give you the shares. This is what all these kids were doing with stocks during 2020 and 2021 is they were buying calls, and forcing the market makers to buy shares. What happens if all of a sudden this open interest goes up to 25,000? Let's just say 10,000 more calls are bought. 10,000 calls times 100 shares is 1 million shares total that the market makers have to buy. Well, you just saw what the float is. If the market makers are forced to buy 3% of the company, what does that do to the share price? So I'm explaining to you exactly how all those share prices got spiked up during 2020 and 2021 because all these traders were using leverage. I would never tell you to use margin. They were using margin to buy calls. So leverage on top of leverage to spike all those charts up. So when all those prices got super high, And I told you they were going to come down 60, 70, 80, 90%. You laughed at me. Some of you called me stupid. Said it could never come down that much. Remember the kid who I don't think is a member anymore? And if you are, glad that you stuck around. When ARK was like through the roof and I said it was going to come down to 80, maybe 60, maybe 30. No way it's ever going under 100 again. What's ARK? What's ARK right now? Okay, 38? I don't know. I don't remember exactly. Maybe pull it up. 38. There you go. So let's take a look at this 5-year chart. So when this was 137, I says for sure coming down to 80, probably 60, right? When I was up in here, and I actually have an article out there. When I was up here, I told you it's going to lose a lot. Said for sure 80, probably 60, maybe 30. It hasn't gotten to 30 yet. There's one more leg down in the stock market. It will. It's how it works. It bought calls on leverage. I think that this is so close to a short squeeze that if it's something that you would do and you understand, not take a big position, you just want to add a little juice on the rebound, buy those calls. Somebody asked why not the 250? Because you're not getting any leverage on your money. You might as well just buy the shares, right? That's why. So I think the $5 are pretty cheap at 30 cents. And if you're just, if your idea is that you would sell when the stock got to 10, then I think the $5 ones are pretty good. My target price is 17 to 22 by the end of the year, by January. So, right? Because when they announce the India IPO, which I do think will get announced before year end or right at the very beginning of next year, I think the stock moves pretty good on that. But I think it moves a lot on the tax guidance from the IRS, and I think it moves a lot on LCFS over the summer from California. I think that they probably have a joint venture partner coming in on the natural gas. They've already hinted at that. They've told you approximately when the India money's coming. And I just don't know how much more they can lay this out. And now it's not so much even a 5-year plan anymore. Everybody understands the 5-year plan, right? That's why everybody's here. And some of you are skittish because, oh my God, stock price went down. So that's why I spent most of my time explaining how the short squeezes work, how the shorting and the short squeezes both work, and how buying calls forces market makers to buy shares. And I think, and this is the reason I've started buying the calls myself. Hopefully the idea catches fire. I'm buying calls myself. I'm the open interest right now. Me and my clients, but me too. And I haven't bought much. I've only bought 3,900. Right? It's not like I'm diving in there with 50% of my money. It's, it's a percent, maybe 2 or 3. I'll probably buy one more batch of calls as it goes up if it looks to me like the short squeeze hits the kink in the curve. But right now, taking that position, those 750s at 15, maybe 20 cents, I think they'll be up a little higher on Monday. If that's in your interest, then buy some calls. Or if you don't want to deal with the calendar, if you just don't want to deal with the calendar, $2 a share on Aemetis is, I think they're giving it away. I think they're giving it to you. So if you just want to own stock, just buy stock. Now, I have to thank Shooter here because I watched some things that he said over the last 6 months, like come true over and over again. It's not so much the Elliott wave. That's just kind of a framework. That harmonics thing that he does, holy shit. If you really want to be a trader, then you need to sign up for the RARE service over at Fundamental Trends. Use the code RARE50 and you'll get half price forever. I'm not going to publish that anywhere. RARE50, capital RARE, right? All the letters capital, all caps, RARE, the number 50, 50, RAR50. They get you 50% off forever on the Fundamental Trends RARE service. When I get back in town, by the end of the month, we're going to have the new site up with the new chat rooms. There's going to be 5 chat rooms, one for RARE, one for retirement income options, which is where I'll spend most of my time, one for just general stocks, one for ETFs, asset allocation. Then we're going to have just kind of a broad one. I think that's what it is. I think those are 5 we're going to do, right? Yeah, because I want the free people to have a place to talk a little bit. All right, let's do question and answer at Fundamental Trends. And this is really, right, so here are the services at Fundamental Trends, right? Special Reports Library is basically the blog and the reports. Global Trends ETF, Sustainable Growth Trends, Retirement Income Options. Margin of Safety Investing is the same as Retirement Income Options, right? If you want to trade more, if you want to swing trade and you want Shooter to guide you, then you go to Rare Investing. But like I said, 4 out of 5 of you should be happy with Margin of Safety Investing and Retirement Income Options. Only if you want to be a swing trader. Now, I will say that $1.99 service on YouTube is the shortcut to getting inside of Shooter's thinking without having to do the trades, right? If you just want to kind of understand how things are working, but you don't actually want to trade, the Shooter shortcut is buy his $1.99 a month service on YouTube. Why is it $1.99? because A, it's a tease, but B, I don't want to give away the trades in real time. Anybody who's not paying, because that's not fair to the people who are paying. So that late shots show that he's doing now. Every afternoon at about 2 o'clock, we're going to put up the joining information. Right now, he's just recording it. But at an hour before close, he's going to do something called late shots, 20 minutes live. This is what I'm looking at going into the close. Here's why. Here's what happened today. Here's what I'm looking at going into the close. 20 minutes. That's it. And that's really designed for those of you who want to trade, but it's fantastic for those of you who just want kind of a summary of what's going on and to understand thinking behind the trading network that influences prices so much, especially on small caps and those 7 biggest stocks, because there's so many people if people are investing in indexes through their 401k, they're piling into, those 7 biggest stocks, which are Amazon, Alphabet, Apple, Nvidia, Meta, Tesla, Microsoft. Those 7 stocks are 37% of the market? Yeah. So anytime there's inflows into the market, those 7 go up. What total percentage would you recommend for Amedis? Well, so here's the thing. If you're as aggressive as me, and I know that I'm managing money that's not aggressive, so I don't always give you all my trades because my personal trades really are truly aggressive. I have 10% of my money in Aemetis, plus a couple in stock, plus a couple of percent in the calls. And I even have some July calls, which I'm writing off at this point. So if I get lucky and get my money back, if I make money, that would be fantastic. But, that was based on those catalysts coming in at the front end instead of on schedule. Looks like it's just going to be on schedule. Now that I say that, hopefully something comes in fast. I don't know that many people should have 10% of their money in any one stock. You have to be very aggressive, very risk tolerant, very patient, and you have to pay a lot of attention. Go up to 10%. Most people, a normal position is between 2 and 4%, right? A double position is 6 to 8%. So essentially, I'm at a triple position, which is not something most people should do, but I did it with Exact Sciences and it paid off. Haven't done a triple position since that I can remember. Maybe there's been a few that I traded for a minute, but I'm in this one to make another $1 million. That's why I'm in this stock. So, I've got, what do I got in this stock? Yeah, too much. But, that's how you got to look at it. You have to decide what your risk tolerance is. 2 to 4% is probably right from almost everybody. And if you want to have a little trading position in the short run using those calls, try to catch a short squeeze. If you understand how that works, go ahead and do it. If you don't, just buy a handful of shares with the intention of selling a batch on the way up, But I do think that the target in the next year or so on Amedis is between 17 and 22. That's what the charts are saying. Shooter's charts and my charts. Remember, we do things differently, right? I'm using something called Wyckoff and then volume weighted analysis. He's using Elliott wave and harmonics. We both do all the other stuff at the bottom, right? All this stuff at the bottom. Oops, didn't mean to do that. So, you have all this stuff too. We both do this stuff. And then he uses Elliott wave and harmonics. I don't even understand harmonics. He does that really cool charts. I just believe him because of what I've seen. But I use this. I use the volume weighted. So we are in a spot where institutions that are allowed to buy are going to buy. And I think that if we buy calls, we force the market makers to buy some shares. And I think it's pretty easy to blow these shorts up. So I expect another spike like one of these. And then you have to figure out what you need to bring your position down to so that your asset allocation based on your risk tolerance is where it belongs. So if it jumps to here, then you have to decide, okay, how much should I really own? Then you sell some. All right. I will post this as quickly as I can. Take care.